Welcome everyone, and thank you for joining our COVID-19 webinar update for not-for-profits and charities. My name is Tanya Lopez, and I will be your moderator this afternoon. I hope you are all well. Before we get started, just a little bit of housekeeping. Questions will be addressed at the end of the presentation. You can type them into your Q&A box found on your Zoom control panel. So today our panel of experts will include Aidan Smith, our Head of Not-for-Profits, Matt Hocking, Director of Restructuring and Risk Advisory, and Mariana von Lucken, Partner in Tax Consulting. Our agenda today will include, Aidan will cover an overview of the environment, and Matt Hocking will talk about the SME commercial leasing principles, and Mariana von Lucken will cover the JobKeeper and what's new. Without further ado, I'll hand it over to Aidan Smith.
Thank you, Tanya. Good afternoon and welcome all. It's been a couple of weeks since we've had one of these seminars, so it's good to see a lot of you here again. For those who are actually here for the second time, we had a seminar on financial reporting this morning that some of you might have attended, so sorry you've got to put up with me again. And yes, I am wearing the same shirt that I wore this morning. I didn't go through a wardrobe change. Now, just a brief overview of what's happening. As we mentioned in the past, ACNC came out a while back regarding extensions to financial reporting, AGMs, etc. So financial reporting, lodging with ACNC, you've got till the end of August now for year ends that are December onwards. June year ends they haven't said yet. ASIC have come out since we last spoke. ASIC have come out and given everyone effectively an extra month. So if you report to the ACNC, they've not come out and commented on June year ends yet, but other year ends have got an extra to the end of August to report. And if you're not reporting under the ACNC, you're reporting under ASIC, then you have got an extra month to report. So instead of 4 months, you've got 5 months. For other bodies, I recommend you have a look at the website for those, or reach out to us and we can give you an update on all of that. Also, what's a reminder for those that the flexibility under the Corps Act regarding the 6-month safe harbour from relation to insolvent trading. Now, be careful about this. Matt, he's not going to talk about this today, but Matt's an expert in that. So just to remind you all that this isn't a get out of jail free card and you say, okay, we can't be done for insolvent trading for the next 6 months. You still have to be very careful about that. So if you do have any concerns about cash flow, going concern, please reach out to Matt. He's the expert that can help you through that. And just final thing I want to talk about is year end is almost with us. I mentioned the financial reporting update this morning. We talked about a few things there we've got to be conscious of. Asset values. You have assets you carry at fair value, like property, unlisted investments, etc. Do you get those valued normally every 2 or 3 years? You probably should be looking at getting them valued this year, just given everything that's happening. You also have to have a look at whether there's a going concern impact, what impact that's going to be in the accounts. Impairment. In the past, impairment might not be an issue. Impairment might be an issue now. As we've said in these seminars a few times, if you're not sure, please reach out and look at this stuff early. Look at it before year end, because it's complicated material. It can be difficult to try and ascertain what's the right answer, and there's judgment involved. So the earlier you can do this, the better. That's all from me. I'm now going to pass over to Matt, and you're in very safe hands. So Matt, over to you.
Thank you, Aidan. I'd like to thank everyone for attending today. So I'm basically going to just touch on the SME commercial leasing principles. This is a code of conduct which has been released by the federal government, and effectively all the states have now legislated for this code so that it has now become law in all the states. How the code works, or the general principles behind the code, that it relates to commercial tenants. So that's all type of commercial tenancies, so retail, office, and industrial. It doesn't apply for residential tenancies. To be eligible as a tenant, you have to be an SME tenant, so you should be eligible for JobKeeper, and you have to have an annual turnover of up to 50 million. If you need some help around grouping and how that works, if there's any different arms to the not-for-profit or the charity, we can help you with that. Generally, what the code will offer as general relief for tenants that you would get a rental reduction based on the reduction of your turnover over the COVID-19 period. And that's essentially the JobKeeper time period. Landlords are obligated under the law, which is legislated, to offer proportionate rent reductions, which can be, if there is no revenue, up to 100% of the normal lease payments. In doing that, the landlord effectively has to waive 50% of that reduction, and then they have to defer the other 50%. And the deferral period is either the remaining lease term or a period of 24 months. So there's a few other things that have been built in the code effectively to protect tenants. And that is that the amount of any reduction of the rental waiver may not be recouped by the landlord following the COVID-19 period. Landlords must not terminate a lease for non-payment of rent during the period. Tenants must comply with the terms of the lease, subject to these negotiated changes under the code. If there's a material failure to do that, then you'll release, I guess, the protection that the code provides. Landlords are not able to draw on a tenant security, be that a cash bond, bank guarantee, or any personal guarantee for non-payment of rent. And tenants should be given the opportunity to extend their leases for an equivalent period of time of that rental waiver period. And there's also other things around outgoings that gives tenants some further protection and obviously assists them with cash flow. I'm going to touch on a few other matters. So Tanya, next slide, please. So just a few other matters to touch on that we see as fairly important, not just for not-for-profits, but for all businesses over the next couple of months. And that involves, firstly, reviewing your reporting framework. So that is, I guess, engaging with the board to understand if they have any further reporting requirements this time, given the economic volatility. It may depend on the business's financial position or the board's preferences, but we have seen in some cases, the requirement of weekly or daily dashboards, which are now needed to be prepared, which they may not have been in the past, just to satisfy the information requirements so the board is up to date with what is going on. What we're advising our clients is that they really should know exactly what's going on their organisation in terms of trading and cash flow over this time, given the amount of uncertainties that are occurring in the economy. And that allows the board to be able to pull certain levers and be able to respond relatively quickly with the right information when they need to. So as part of that, we think that all organisations should review their budgets and forecasts, which they're probably doing anyway for the next financial year, and then to really understand the cash reserves and to understand what amounts are tied up in grants, what amounts can be drawn upon if required, and really have a detailed understanding of the expenses in the business is pretty critical at this point. And that'll allow you to make decisions and to be able to adjust the cost structure so you can improve your cash flow position. Given the uncertainty of COVID-19, especially over probably 2020, maybe a little bit into 2021, we really do believe a conservative approach should be undertaken around your budgeting for FY21 and really reviewing robustly your sources of non-grant income, which may be negatively affected by the increased financial pressure on households. Just dealing with a few operational issues, workplace health and safety. Excuse me. We really do believe that, with the strict quarantine measures now being relaxed and people starting to get back to the normality in their lives, that the review of the existing policies that you've put in place should be undertaken during these times. You should look at which policies were successfully implemented. What are the failures? What can be easily resolved? How quickly in the organisation are you able to react to changes in government policy? So, people with more quarantine restrictions put back in place, are you able to react with that when it comes to your client service and your employees? Or if it goes the other way, how quickly can you pivot? So in respect of that, your client delivery, your fundraising, donation efforts, really do need to consider, how this is being impacted by social distancing requirements. Are you still able to undertake the same processes and have the same approach, given the requirements on you around social distancing? And you also have to consider that, do you have to incur a significant amount of cost to be able to comply? And what are the best ways to be able to comply, considering that it may be for a relatively short period of time, that when everything goes back to normal, that you're not incurring a whole bunch of expenditure that effectively is a waste of money, albeit may be required. So we've dealt with a number of industries where being clever about your approach in incurring costs to have to comply, or because you do have to comply with a lot of the government regulations around social distancing and everything else for people's safety, can be essential, so that you're not incurring costs that you don't need to incur. Some of your workplace health and safety things to consider and review would be working from home policies, reviewing physical and psychological health risks for your staff, possible health screening policies that may eventuate in the future. We don't know how long COVID-19 will affect our lives, so it may be that once testing becomes easier, that it may be a private endeavour, and you may be obligated to actually do testing at work. So how you will do that, understanding and making sure that your social distancing policies are put in place, so that your staff are safe in delivery of the services to clients. Whether or not you're actually able to obtain protective equipment or barriers, much like we see now in supermarkets with the plastic protection boards, and also essentially your communication strategy and other issues to your employees, that they're properly informed, and I guess all of their concerns are answered and heard. Other things to consider is your employees' fatigue and workload, dealing with aggression and violence, either by maybe some staff or clients, and mental health issues as people become more nervous and anxious, given if there are further outbreaks. So considering all of these things is really essential when dealing in this uncertain time. Thank you, and I'll pass you over to Mariana.
Thank you, Matt. That's great. Oh, there's a little echo there. Can you hear me? I'll just check something before I... That's right. Just we're up and running. Well, good afternoon, everyone. I just wanted to touch on the JobKeeper. I think it's winding down in the sense that a lot of people are either in or they're not necessarily in, but they might still enroll in May or June or another month where they feel that their business profits are reducing, or their revenue is reducing as we head further into it. And it's really hard to say in Australia, because have we really had such a bad time of it? Well, I think some organisations have been affected more than others. And certainly I've been cocooned here in my apartment, so not going anywhere except for last weekend. So, you are in a bit of a bubble, but at the same time, you can see that this is going to have a long-term effect. So those businesses that maybe didn't suffer for March and April, I can feel that that's going to have a knock-on effect, and you may not feel it. Those that haven't already felt it till, effectively June, July. So it is important to have this JobKeeper in place. I know the government has been talking about slimming it down or doing things to it. Nothing has come out. I think that's just all talk at the moment. I think they'll let it run till June and see in July whether they need to do modifications. And what does a modification look like? It's likely it'll stay in place, but potentially it'll decrease. So instead of 1,500, it might be another figure. And I don't know what that looks like, so I can't even guess. But I guess it's the government has been, and the tax office has been fairly open and generous and answering a lot of questions and trying to assist. And so one of the things is, you've got to have an eligible employer, which you understand is a decline in turnover of less than or 15% or more, unless you are a university or a school, and those effectively don't get the 15%, they get the 30%. And again, looking at that basic test, if you don't meet that, you've got these alternative tests, be it a startup or some other type of business. You've had to have paid your employees the $1,500 by the 8th of May. If you didn't pay them and you're entitled, well, they just don't get paid in April. So, you know, they might get the payment in May. Eligible employees, that's always been a hotspot. Who is an eligible employee? And as you know, casuals have been the ones that have been asked the most questions about what is regular and systematic. And they would have had to be with you for a year. There's questions around, oh, I had that contractor and then they became a casual. Well, I think the question is, a contractor really a casual? No. And they're quite specific, those questions. If you have any like that, happy, we send a message to the ATO and ask them the specific questions. Then therefore it can help to back why you've included someone or not. What's the next step? Well, most of you on this call probably have enrolled. The extension, if you haven't already enrolled, but you've done your top up, but you're waiting for something, 31 May for April and May, JobKeeper is still available. So that means effectively you've topped everyone up, you've sent out your notices, but you just haven't gone on to the tax portal or the business portal and enrolled yourselves. So once you do enroll, that's when you'll start getting it. So if you do enroll around before the 31 May, say, you know, a few days before, you won't get your April or May payment until the first week of June. So it'll all come together then. Keep the employee nomination safe place, make sure you get them. If you've got an email verifying it, that's fine, just keep it. If you're using single touch payroll for JobKeeper, that's no problem at all. That's where you really do all the, that's key, I think, to everything. It's one in, all in, as I've indicated in the past, unless the nomination says no, they're not, or they don't meet the criteria, they're all in. You have to pay them, you can't pay them less. If you're already paying them more than $3,000, you don't have to pay them more. But you know, it's very clear, one in, all in. The banks have gone all out in the last, well, a few days before the 8th of May, so maybe 3 days, to make sure that, you know, you could get some money to pay that. The banks took, you know, effectively gave their bank details so they would get refunded by the government. So, you know, that was easy for them to lend the money. And it was a quick turnaround for some of those. So if you're still having issues with your cash flow and everything, come and talk to us. We've got our debt advisory. They've been fantastic in helping clients. The next step is, you've enrolled, is report monthly. So you get your money by doing that next enroll. That takes 2 seconds. And then the next step is to say how many actual employees. So this is that step is quite important. It's in the first step of enrollment, but the second one is where it's linked to your single touch payroll and you're actually indicating which of your employees are eligible. So that's a quite important step. And a second step in having a bank account. And that's a step where you report what your actual was in April and what your forecast is for May. And you're going to have to do that every month. Okay, so that's just a given. After the month end, that's what you're going to go into your business portal and report. Very important, you report every month. If you don't report, you're not probably going to get your money. And that was the trigger for getting your money. So if I look at the next slide, thanks, Tanya. We already discussed, we've gone through this, and I think if you've already enrolled, it's not so relevant, but just to remind you, basic test, you've got the monthly, test monthly, or you can test quarterly. If you didn't meet it for March, April, you still might be, or the quarter, April to June, for whatever reasons. You may be able to still test for May. If you don't meet it, June. If you don't meet it, July. And then there's July to September. And obviously, as you get further down the track, there's less of the JobKeeper, because it's only once you enroll do you get it from then onwards. You don't go back to April. The biggest thing has always been about what is the projected turnover. So when I'm calculating a month and comparing month to month in the years, so March 2019 to March 2020, you know, what is my turnover, or what should I include in my projected? Say I'm doing May, that's a good example, or May's not so good because we were nearly at the end of the month. So we're doing June. So we're at the beginning, the end of May, and we're at the beginning of June, and we're projecting what our June turnover is, and we think it's going to be less than June 2019. So we're just sort of saying, well, how do we calculate what the figures for June are? And what's been quite helpful, besides the fact that, you know, you don't include your GST in there, and you include your GST free, and you You don't include your input tax, which is, you know, fundraising that you've chosen to include as input tax, interest, dividends, those kind of things are excluded. You include donations and bequests in your calculations. But still, there's still that question of, you know, I've got a grant in April, do I need to extrapolate it over and include it in the June projections? You know, all these kind of questions that come up for not-for-profits. So I think the guide that came out, LCR 2020, was quite helpful in that. A lot of people were already, you know, doing it in some ways in one of the methods that the guide mentioned, and I'd like to just go through that in a bit more detail because it might be useful for some of those that actually haven't met the test yet. So I've talked about what's included and what's excluded. So I might just before I move on, charities can also exclude government grants. Now, I think last time we presented, that was already in the know. Question was, you know, what's a government grant? Well, government grant is a grant that comes from the government. Usually it tends to be a grant that's either classified as GST-free or taxable supply. There can be grants, very rarely, but there can be grants that are not taxable supplies. They're not anything with GST, so they're not assessable. So one of those was the advanced NDIS payment, an advanced one, not your normal NDIS payment. That wasn't taxable supply and it shouldn't be included in your calculations. So that's just something to be aware of. Also, what didn't come out until recently was the notice. So if you decide to exclude, or if you have excluded your grants, there is a notice that you have to give to the ATO. Very simple form. And it actually can be found on the ATO website. And if you go to ATO website, government grants, and we can send you the link as well to the ATO website. It's actually on the ACN site as well. But I think the ATO one's quite simple to read and it's easy to access. So we'll send that when we send the slides out. But if we go to the next slide, what I found interesting about calculating, oh, is that what the next slide says? Am I missing a slide? If I go just forward again, just go forward, go another one, another one. Yeah, I did these slides, so I can only blame myself. What I wanted to cover off was, if you go back to that slide, before I go to the alternative test, if I just look at the basic test, just stay on here, that's all right. You could sort of see that LCR confused a lot of people in the beginning because what would happen is that before that came out, we were emailing the ATO and asking them certain questions about, you know, how do you treat this or how do you treat that? And they said, oh no, for example, a grant, should I spread it or not? And they said, no, you shouldn't. You should just include what's in that month. And then they were saying, if you didn't get a grant in March 2020 and you got the grant in 2019, they were saying it's not comparable. And so it made it quite confusing. But then when the LCR came out, they then went through in there and gave you different alternatives. So one is where you looked at the strict definition of what a supply is. So what a supply is when you provide the supply. So say, for example, you might invoice in March, but you don't provide the supply until June. So that's when you provide the supply. It might be that you get a grant in February, but you provide it over 6 months. So that's when you provide it. So that's what the strict definition is sort of looking at in a very simplistic way. But then it also said the ATO allowed you to apply some alternative methods. So these methods were effectively, you could use what your financial account said. So if on financial accounts you spread an income item, well, you could spread it when you're doing the calculation for the basic test. And then if you didn't want to do it that way, you could also use the GST attribution, which is basically use what's in your BAS, which is what a lot of people have used. And that is the simplest form of it. Obviously taking into account those exclusions and inclusions as we discussed. So they were kind of like the 3 methods you could use. So I think there's an opportunity there if you look at May, there's a new opportunity to say, okay, the GST attribution test maybe doesn't work for me. What do I do for accounting? And then if that doesn't work, what do I do under the strict definition? So it's worth considering if you didn't meet the rules for March, April, and that quarter. So if you're looking at May, June, going forward. So it's not to confuse you, but I think what that has done is opened it up. It's given more opportunities to meet the test, especially for not-for-profits. So if we go to the other slide. So there might be a scenario, now don't get this confused the alternative method in the LCR to the alternative turnover test, which is Commissioner's discretion. So that means that for certain type of entities, so if I go to the next slide, Tanya, so for certain types of entities, so if you've commenced a business, you've acquired or disposed of part of your business, you've done a restructure of your business, you've had substantial increase in turnover, you maybe have irregular turnover, etc. There might have been a drought, so then you had some exclusions there. Well, if you fit one of these scenarios and you don't get into the basic test, you do not get into the basic test, you can use one of these Commissioner's discretions. Okay, and the last one they brought in was the service entities, where you might have all your employees sitting in a service entity, and you would definitely, probably likely not meet the definition of drop in turnover because the operating entities dropped in turnover. And that looks at the operating entities and their drop in turnover. So that was a really good ruling to come out. And I know not-for-profits use those as well, so that can be beneficial. So, so there are lots of opportunities to meet the test. It's only obviously if you have an impact with COVID. If you haven't had any impact at all, then it's likely you're not going to meet any of these tests anyway. So if I just go to the next slide. And we just talked about the alternative test. I just wanted to alert, there is a ruling that's come out about schemes. And it does talk in there about if taxpayers have deferred their invoices or done things to manipulate their income so that they meet the drop in turnover, which, you know, you do hear about in the sense that I haven't actually seen anything or heard about it from our clients. I just think more of our clients are concerned in getting it right. Plus, I don't think I would assist a client to just go into the turnover unless, you know, they met the conditions. There is that, and the point of that practice statement is to really just give a guide to taxpayers, and also just to let you know that if you are doing things to intentionally to contravene the law, is when the ATO will throw the book at you and charge you interest and penalties and give me back the money, sort of thing. So if you're doing the right thing and you're documenting, that shouldn't be you. Just to reiterate, registered charities elect to exclude their government revenue for the turnover. You can do so. You need to notify. So that was a new thing because you didn't have to notify. According to the media release, there was nothing on that. It was only when the legislation came out did you have to notify. And look, it does say 7 days about the notification, but I think if you get it in now, you'll be fine before 31 May. So if you have excluded grants from your calculation, then you just need to complete the notification to the ATO, and all the details are in the email link we're going to send you. And you do have until the 31st of May, so don't panic. We've got a couple of days left. I think they've been generous here with, not generous, but I think they've taken into account religious institutions. They don't have employees as such. The religious practitioners, so they're able to get the JobKeeper, and I think they've been applied to those. And then there's some other exemptions there for specific entities. I know that schools in general have had a lot of questions. I know that the ATO has put on a specific webinar for them and raised and given them some questions and answers about school fees and discounting and so on, and what's included and what's not included. So if you are a school, I'm happy to share that with you as well. And just let Tanya know, and we can send you some of their slides. So next slide, please, Tanya. So what we've been assisting clients, just in general chit chat, but going through their calculations to see if they meet it. I know there's still clients that haven't met the JobKeeper turnover test. So, they'll be testing on a monthly basis, and they'll be keeping a keen eye on their revenue. So what to do if you haven't already enrolled for April, May, because you're waiting for something, you've got till the 31st of May. Keep your employee nominations. You should have topped up people by the 8th of May to get the April payment. If you haven't done so and you're eligible employer, they're not entitled. They won't get it. It'll be in May. They'll get it then. If you've not enrolled, test monthly, test quarterly, and top up your staff, and make sure you enroll in the month that you think you're eligible. Actual and projected monthly declaration forms, they will need to be made. One thing to note on these projections is that whatever methodology you followed. So remember I said there's the basic test and there's all 3 methods to do. Whatever methodology you followed, follow the same when you're declaring your actual and projected in the declaration form. Just use the same method. So if you used your BAS, excluding GST and all that, use that same method when you're doing your actual and projected. And that's usually available on the business portal, and that'll be available in the first week after the end of the month. I am assuming a lot of you have already got JobKeeper for April. Maybe if we could run a poll question for those that already started receiving the money, those that have enrolled for March or April, if you could just identify if you're starting to get the money. I have seen it come in. The cash boost is all coming in as well. There's been, I think, some delays on the cash boost. That's different than JobKeeper. What's the difference? Cash boost is a gift, non-assessable. You might put it in your P&L and your income. Doesn't matter for not-for-profits because they're not assessed anyway. But the JobKeeper in itself would normally be assessable. So the employees getting the JobKeeper top-up would be assessed on it, it'd be in their payment summaries. You obviously, as an employer, are not-for-profit, so you obviously wouldn't have to pay tax on it. It would be in and out anyway for most employers. If we go to the next slide, I think that might have been the end of the slides. Yeah, look, we are helping clients. If you do need some assistance, if you haven't thought of something, if you want to run it past us, I'm happy to chat, no charge. If you want us to look at something a bit more in depth and you want us to send us the spreadsheets and look at it, you know, we'll tell you up front what it costs. So I think we're trying to be as generous as possible with all this. So if you'd like some assistance, let us know. I'm happy to follow you up with a call and go from there. Now, for those on the call, just while we're here, and you know, it is coming into that tax season. Obviously, you don't pay tax, so bad luck for me. Good luck for you. But something to consider is a lot of not-for-profits have FBT. You do have fringe benefit tax. You need to consider if you're entertaining. If it's not a salary package entertainment, other entertainment, if you're providing cars, are you over the limit in any way? You're providing in excess of that, and I know some do. So make sure you're completing your FBT forms. We all have till the 25th of June. I mean, that's a natural extension for tax agents, but all those that aren't with tax agents, you've got to the 25th of June to lodge your FBT return. Should you need extensions, just get that from the ATO. I mean, I'm sure that they're very agreeable at the moment to do most things. Like if you need more time for anything like a BAS, most time you want to lodge your BAS because you're getting the cash boost. But if anything you can't get to because the organisation is short of people, the tax office is being very generous. So either call us and we can assist, or you just call them yourself, whichever you like. So thanks, Tanya. So probably questions, I think. If they've got some questions, I'd really like to hear from you.
Yeah, all right, thanks, Mariana. We've got a few questions that have come through. Remember, if you do have any, just type them in, go to the Q&A. We'll go at the bottom of your screen and click on that and type the question in, and we'll go through them. So the first question, Mariana, so regarding the COVID cash flow grant, so the lump sum came in when the January to March GST return was lodged, and then when I lodged my April PAYG amount, I got a further credit, but I wasn't expecting anything till June. Do you know how this is meant to be working?
Yeah, gotta love that when money comes in and you don't expect it. Isn't it lovely? So it's a $100,000 cash boost for each employer. So each employer, so you might have 3 employers, each one should get it. Now it's limited to 50,000 for the first quarter and then 50,000 for the next, which you're right to say that you're going to probably get something when you lodge your June BAS. But what happens that if you lodged your March BAS and you didn't get the full 50, you potentially could get a top up. So as long as your salary and wages are over that minimum amount, so you've got the 10, that's all you're going to get, 10 now and 10 later in July. But if you're over the 10 for March, you would likely get a top up for any PAYG withholding for April. So if you look at what you've already received, if you haven't received 50, you'll probably get some more in May, and it'll only be up to 50,000. Then you'll get again what'll happen, the way it'll work if you're a quarterly lodger is that you'll get 25, so you've got 50,000. So you get the total of 50,000 by June. You'll get 25,000 in July and another 25,000 in October. So nothing more. The second half will be nothing, not based on anything besides of what you got in your first half. So what you get from March to June will be exactly what you get in July to October. The only difference is if you're quarterly, you only get 50% in July and 50% in October. But if you're monthly, you would have got, it gets split over 4 months. So you get, if you've got 12,500 in July, 12,500 in August, and so on. Yeah, it's very bizarre, but you know, it's just a cash boost. It was there because, you know, a lot of businesses had to shut. It probably came a little bit too late for some businesses because, you know, they were probably suffering back in March, and this payment only came in, it triggered on the 28th of April. But, you know, again, it did come in, and I'm hearing from a lot of businesses that's been very, it's been a relief because that's come in, plus the JobKeeper's come in. So at least they're seeing something come through. Motivation is called.
Thank you, Mariana. Matt, this next question is for you. So here we've got a not-for-profit, it's a small team, and obviously care for each other's well-being. So we're trying to find a balance between maintaining people's mental health, because obviously mental health has been impacted when everyone's working in isolation, and the need to return to work in a safe manner. So do you know if there's any best practice to safely bring people back to the office? There's been government guidelines that are quite clear in retail, but a bit vague in other areas. So is there any best practice out there?
Look, I mean, you know, we're not all Donald Trump. We do need to rely on medical advice, and we should be relying on you know, the Department of Health's guidelines and Safe Work Australia and the chief medical officers in each state and federally. So look, I haven't seen it. We will look to. I'll talk to Victor and to collate some material on that if it's a pressing issue for clients. I can imagine that probably, given how quickly things are moving, that the guidelines will take a little bit of time to catch up. I have seen, you know, some material from various law firms around what, you know, they think is appropriate after reviewing the government's guidelines. But I think, you know, a lot of it is common sense in the sense of, you know, if the guideline is that the people should keep 1.5 metres apart from each other, then how do you facilitate that where, you know, one, you can enable that to happen in your workplace, they're not sharing any materials, and if they have to work together more closely, do you have to consider, you know, providing PPE, their face masks or protection of people's eyes? And, you know, if you can't do that, then you may just have to leave people at home.
Yeah, actually, Matt, I mean, can I just add on that? I thought a smart idea, which I didn't come up with, unfortunately, but I thought the smart idea that our firm did was they sent a survey around to all staff and said, ask them those preferring, because I just noticed there you've just put, Victor, you've mentioned that, you know, those suffering from isolation and mental health. So we sort of put an email around the survey saying those that prefer to come back as soon as we can open the gates, if you like, please select if you want to come back straight away, or if you're still happy to work from home until you definitely have to come back. So that sort of gave us a bit of thinking about, you know, how people are feeling and those that needed to come back to the office sooner. So I think that was going to be useful because one of the biggest things is, you know, how do you deal with the kitchen? You know, I know it sounds funny, but you know, you've got cookie jars there. Well, we do anyway, but they'll be gone because, you know, cookie jars, you've got to put your hand in there. It's contaminants. All those little bits and pieces, making sure people keep their distances, you know, even go to the bathroom, making sure you're not crowded in there. You know, it's practicalities. But even, you know, getting in the lifts at work, you've got to have 2 in the lifts. But I understand they're looking at those rules because it's just not practical for buildings to have 2 in the lift. Yeah, sorry, I just want to add that too.
The cookie jar's going to be gone.
Yeah. Staff committee, sorry, Aidan.
All right.
Unless they can individually wrap each cookie, which is possible.
The next, this is Richard, thanks for this is a clarification point. So the federal court decision in casual workers who worked regular and predictable shifts with a firm advance commitment to work were not casuals. and that's despite how they're described in their employment contracts. And because they weren't casuals, are therefore entitled to be paid annual sick and carers leave. So just a reminder to be careful about how you classify, that's contractors, casuals, etc., and to get any advice if you're not sure about anything. Okay, the next question. So we pass the test, whether you include or exclude grants. That's the turnover's gone down, whether you include grants or exclude grants for different periods. If that's the case, do we still have to fill out the notice for excluding grants?
Well, look, I'd say to you, if you've passed it with including the grants, I wouldn't bother, because why make your life difficult? Because then it's another notice you've got to send. If you passed it and you had to exclude the grants, then yes, go down that path. But no, if you've already passed it, including the grants, practically I wouldn't bother going down and filling that notice, because you only have to meet it once, the test.
Okay, thank you. Next question, we enrolled before the LCR came out. Is that okay?
Yeah, look, that's fine. Look, it even says it in the LCR that so long as you've done your calculations in the manner that was available at the time, so support your answers, I always say, and the logic of it. So, for example, you might have asked me the question, could I spread my grants? We've asked the ATO and they said no. I've come back to you and said no. So you've had to work it out in another method, and we've sent that to you anyway, the question and the answer. So yes, you've got that something to support.
Thank you. Grants, excluded grants, does that include the BAS credits, something the GST?
Sorry, where's that question? Does excluded grants include the BAS credit? Yes. So the cash boost is not included as a grant. Cash boost is nothing. So it's not a taxable supply or anything. So it actually says that in the LCR, it clarifies. And the JobKeeper isn't assessable either for the purposes of your assessment.
Okay, next question, Mariana. JobKeeper funding, confirm when you get the JobKeeper funding, that's excluded from your turnover calculation.
Yes, that's correct. Yeah, so when you're calculating your monthly projections, you exclude your JobKeeper. Again, the LCR states that.
Thank you. And next question is for me.
Oh, there you go.
Yeah, I'll ask myself. The accounting treatment for the cash boost and JobKeeper payments. Now, interesting you asked that. There's different thoughts on it. Mine in relation to the JobKeepers would be included as a revenue item, but you should be disclosing it separately in the face of the P&L account. But the AASB, so the Australian Accounting Standards Board, they're going to come out with some Q&As in the near future about, and then one of them is going to be in relation to the accounting treatment, because they've been receiving many questions and there've been differences within the AASB itself about how this should be accounted for. So as soon as that's released, we'll publish that and make this group aware, and I'm sure next webinar we'll mention it too. So watch this space and we'll keep you up to date regarding that. All right, next question. I've noticed that DGR and the words in Australia come up regarding JobKeeper. Do you know anything about this?
Yeah, that's to do with one of those. So if you have a look at the last legislation that came up, and the overseas aid organisations. So you might be an overseas aid organisation, you're not in Australia, and the question is, can you be a DGR and so on. So they're specifically allowed overseas aid organisations, and if you're not one of those, don't worry about it. But if you are one of those, there's the rules around that.
Okay, thank you. We have a couple other questions regarding how you treat the JobKeeper and the cash flow boost. As said, we'll keep an eye on what the AASB release and then let you know about that. Then we've got one, we just did that, had the 60-40 split. It's my comment. The only thing we can think of is to treat ourselves as a retail business restaurant and try to match that standard. Yes, so that's the, thank you for that, Victor. And now we've got a couple other questions just in relation, they've gone through the chat box. We'll just go those. Excluded grants include the BAS credit, we've answered that one. And the accounting treatment, we've answered that. Yeah, there's a comment. Many not-for-profits won't be able to afford to go back to the office straight away if you have to pay for cleaning every day. It's a good point. I've also heard from someone else that if you do find a case of COVID in your office and you have to get the office thoroughly cleaned, that's not a cheap, that's not going to be cheap. It's
They
quite
call
a
it
quick,
forensic
quick solution.
cleaning.
So there's a significant cost there. So you got to think about that as well. Yeah, there's a lot of considerations about whether you return to work or not.
And isn't that a choice though the employer makes itself? Like, it depends how big your organisation is, but if you want to, you know, if people are happy to sort of work from home and you're still, you know, getting the output that you need, then, you know, why not delay it?
Yes, yeah. Do you want to take unnecessary risks? We're talking about the city, our office. What people get public transport into the city. They're restricting buses to 12, trains to 20 something. Or if you're driving, it'd be a very inefficient use of time if you're standing waiting for a bus for an hour or so, or driving in the car. So there's a lot of other considerations. The cost of cleaning, etc. It's not an easy decision to make.
Well, actually, none of us are actually in the office. We've got our background there, so just don't think we're being hypocritical here. I'm sitting at home in my living room. I'm sure Aidan's sitting at home somewhere. And
No,
Matt.
no, I'm in the boardroom.
Yeah. That's why you've got an angel head.
Yeah. We've got a couple of other questions that have come in since we're talking there. The first one: if we pass the test without government revenue, when we submit our monthly report, do we still have to submit the revenue in the same way, or do we include government revenue?
So no, so they ask you to report your monthly the same way you would have calculated your JobKeeper. So if you've excluded grants, then when you report, exclude the grants.
Yep, thank you. And then one other that's come through in the chat. JobKeeper, if you exclude government revenue, do you have to exclude employees covered by that funding?
Well, it's a choice. It's not you have to. It's a choice that you can make. So it specifically says that it's a choice that if you do exclude your government grants, you can exclude the employees that you know would be entitled to the, you know, get paid from those government grants. But again, you don't have to exclude them.
Okay, thanks Mariana, thanks Matt. We don't appear to have any other questions, so we'd like to wrap things up. If you do have any questions about anything that's been covered in today's seminar or anything else you're not sure about, please reach out to us. We've got a poll here that's come up if you want to be contacted regarding financial reporting or the Leasing Code of Conduct that Matt talked about, JobKeeper Mariana talked about. Please answer that polling question now.
Yep, and I just wanted to let everyone know that the slides and the recording will be sent to everyone in the next day or two. So I just wanted to thank our panel of experts, and thank you for everyone for joining us this afternoon, and we hope to see you again.